Good afternoon and welcome to another of the TradeStation webinar series. This afternoon we're going to talk about preparing option trades for October and beyond with Dan Sheridan, the founder and the CEO of Sheridan Options Mentoring. Dan Sheridan has over 25 years of experience trading options and educating traders worldwide. He's a veteran CBOE market maker who worked with the highly successful specialist firm called Mercury Trading. Dan teaches professional and retail traders through many additional channels. He hosted the weekly CBOE TV show Options Safari at cboe.com, and he as frequently does, in addition to working with TradeStation educational webinars, he does webinars for the CBOE and many other brokers as well. And he also has his own TV show called Sheridan TV that airs weekly at sheridantv.com. We welcome Dan today. I'm Don Prattle, your Director of Trader Development and Education here at TradeStation. Before we start, I want you to know that our presentation here is for educational purposes only, and all the symbols and all the trading ideas that we discuss are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind any place where TradeStation is not authorized to do business. Active trading may not be suitable for you, and please bear in mind that options trading carries a high degree of risk and is not suitable for all traders. I've posted in the chat panel a couple pieces of disclosure information regarding the characteristics and risks of standardized options and other asset classes that we cover here at TradeStation, and also a link to the Video Archives YouTube channel that TradeStation maintains. Now, your first question is going to be, is this presentation recorded? And the idea is absolutely yes, it's going to be recorded, and it's going to be posted in our Video Archives in the YouTube channel sometime later this week. Now, which brings me to our presenter today, Mr. Dan Sheridan, the CEO of Options Mentoring. Dan, how are you today?
I'm okay, Don. How you, as the Italian guy says in the commercial, how you doing? I'm doing good.
How you doing? All right. Okay.
Ready to go. Can you guys hear me okay? Welcome, everybody. All right. We'll do another testing 1, 2, 3. Testing 1, 2, 3. Does that still sound loud? Up a little more. Okay, now it's up a little more. Dick, are you messing with my mind? All right, how's that? How's that for a good? All right, well let's move on here. So happy to be here, everybody. We'll jump in as I'm looking at October, which is usually the last big potential for volatility in the market. You have earnings coming up in October. And historically, we've had a little bit of movement as you move into October. And then after October, you have Thanksgiving and Christmas, and usually not too much going on. The environment we're in right now in the market, we're at record levels in the S&Ps. And I know we've all been looking for a correction, but the market keeps chugging along here. So we're very high levels of the SPX and very low levels. I think we closed, under 10 in the VIX today. So I'm going to just talk about 3 strategies, and that makes sense to me for the current period now, and we'll just talk about it. Let me just start out by saying, how do I look at trading and what do I do? I've been trading for a long time, like Don. I was probably down, Don's career, Dan Prattle and myself, probably down at the CBOE for most of the same period of time. And now the last 15, 16 years or so, I've been teaching retail traders how to bring in monthly income. And so my approach is probably much different than you're used to seeing. You're probably used to seeing a lot of people where they're starting out of the gate. Hey, let's look at IBM. Let's bring up a price chart. Well, let's see where we think it's going. Here's gold. Let's bring up a price chart. Let's see where it's going and then match a strategy. Right? Would most of you say that's what you're used to seeing? A lot of, hey, this is a vehicle. This is, whether it be Fibonacci or Fibonacci or whatever. You're used to some kind of chart and then make a decision. Whereas I'm just a little bit different than that, even though I'm aware of where price levels have been, and I think technicals are a good tool. I really do. But in terms of consistent monthly income, I think it's very difficult to what I found, just my personal experience and working with many students, to pick the direction of the market on a regular basis. And so what we do is we just mainly teach people to put on repeatable trades that you would put on every week, every month, repeatable trades over and over, pretty neutral positions, not really leaning up or down in terms of your Greeks, that you don't really, you're favoring more of a sideways type pattern. And we're relying on time decay, that the options we're selling are going to decay quicker than the ones we're buying. So we might do strategies like some types of butterflies, credit spreads, calendars, iron condors, double diagonals type strategies. And then we just have simple risk management on these strategies, and we do them over and over again. And what I found is that works much better, in my opinion, than technicals, and it's easier to teach people. Technicals, I think, is tougher to teach people. And okay, here's IBM, here's a chart, here's what we think. Whereas we're putting on, for example, we'll look at SPX and put on a butterfly every Wednesday, or an iron condor every Thursday. The duration may change, like maybe a butterfly every Thursday that's 15 days from expiration, or an iron condor every Thursday but it's 30 days from expiration. But we put these repeatable trades over and over, so we don't spend a lot of time, where is this stock going or where is it not going. Anyways, a little bit different approach than maybe most of you are used to. With that being said, today, am I going to cover maybe one of the three strategies would be like we regularly do. A couple of them are more preparing for the October stuff. All right, so let's dive in here, and I'll give you three strategies that I think, and I'll let you know how I would do them. And all right. All right, this is for educational purposes today, this session. And let's go to the next slide. All right, so here's the first example. I will call this a covered right for the downside. It'd be a long diagonal. We'll talk about some of the logistics here. And we'll do it on the put side. But this would be called a long diagonal covered right for the downside. Has anybody ever done one of these? Has anybody ever done one of these? Yes, no? So most of you are probably familiar with covered rights. And over the last couple of years, they've done great. Why? Market's gone up. And so here is a strategy that if you're thinking, you know what, Dan, boy, a lot of my retirement has done really well over the last year or two. Everything is kind of leaning long. It's done well. I've got a lot of covered rights on. They're doing well. Does anybody have covered rights on? Any of you doing covered rights or long diagonals on the call side, kind of a covered right type trade? Anybody have any covered rights on? No? So this would be a position that could hedge some of your portfolio on the downside, It could diversify. Maybe if you have a lot of covered writes on, here's kind of a covered write for the downside, but instead of using stock, I'm just using options, so it would be a lot less capital. And so this would just be something to get some hedge for the downside. So let's walk through the logistics of this, folks. So this is an example I took when SPX was trading at 25.10. You with me? Here's an example when SPX was trading at 25.10. And you can see here, 25.10. And the example was, I went out to November, so my long option was 44 days out. And by 1 November 10 expiration at the time, 25.30 put. So I bought an in-the-money put, about 40 points in the money. The delta of my long put was about a 59. So again, this example was taken on September 27th when SPX was trading 24.90. It's a bit higher. It's about 30 points higher today. And so covered rate for the downside, I'm buying an in-the-money 25.30 put. Has a delta. Here's a symbol for delta of about a 59. And I sell one October 27 put, 30 days from expiration. I sell 24.90 put at the money put. So I sold an at the money put. Excuse me, I said that wrong. Sold an out of the money put, a 24.90 put. SPX is at 25.10 on September 27th when I did this. So sold 24.90 put, had a delta of 34. So I bought an in the money put, sold an out of the money put. My long put was 44 days from expiration. My short put was 30 days from expiration. The debit on the trade, it paid about 21 bucks, $2,100, 21.20 in this example. So margin for one contract, 21.20. This is the expiration graph, so you can see on one contract, this is the expiration graph. You can see looking to make almost $2,000 on the downside, 24.90 and below. That's just one contract. So about $2,000 on margin of 21.20 or capital, risk capital, would be about 10% yield, right? On the downside. You can see here at expiration potential to make about $2,000. That's 2,000 there. It's a 2,000. And divided by the capital of 21.20, it'd be about 10%. So that's what it looks like. And so again, this is just looks like a covered right. It's the same graph of a covered right, isn't it? Just to the downside. So this would be a long diagonal. So I'm just using put. I'm just using puts here. If I did it on the upside, it would just be using calls. So I'm buying an in the money put, selling an out of the money put, and these are just at least some ideas as far as where I would sell the put or buy the put. All right, so you have that, about a 60 delta for the in the money put, about a 34-35 delta for the out of the money put. I'm selling a put about 20 points lower than the current price at the time, September 27. Again, my long option was 44 days from expiration, the Nov 10 expiration, and my Oct 27 expiration was about 30 days out. Does everybody see that? All right. And so that is, you say, when would you do that? You know, when the market's at these high historic levels, volatility is low. And what's nice about this, the beginning Greeks of this position with SPX at 25.10, and VIX under 10 as of September 27th. Deltas were short a little bit, 23 deltas short. And what does that mean, 23 deltas short? Again, think of deltas as stock equivalent. So if we go down $1, we'd make $23. If we go up $1, we'd lose $23. If SPX goes down $10, all things otherwise being equal, 10 times 23, we'd make about $230. So your short deltas is being like short stock if you're going down. It has positive theta, so our short options, the OCT27 puts, are decaying quicker than no 10 puts, which were long, because they're closer to expiration. Our shorts only have 30 days till expiration, our longs 44. And unlike a covered right, which loses money if the volatility goes up, here you benefit from volatility. Say, Dan, why do you benefit from volatility, and what does that vega of 69 mean? Because I'm long a further out expiration, the Novembers, I'm buying more time premium than I'm selling because I'm buying a further out expiration. So when this 69 is a theoretical number, what it means is that the option volatility of my long put and the option volatility of my short put goes up 1 point, I'd make about $69. If the option volatility of my long put and short put goes down $1, I'd lose $69. Hey, Dan, why would you make $69 theoretically? That's a theoretical number. If the option volatility of the Novembers and the Octobers went up a point. Because again, remember, I'm buying more time premium in my November 25-30 put than I'm selling in the OCT27 put. Why? Because I'm buying a further out duration. So if option volatility increases, which usually happens when the underlying goes down, I would make more on my long than I'd lose in my short because I'm buying a further out expiration. So I think this is a very favorable position that could be used as a portfolio hedge. This could be used as to diversify. Maybe if you got a lot of vertical or covered rights on, betting that the up move continues. This just gives a little bit of hedge to the downside. And most of you probably have more capital in your portfolio betting on the upside than the downside. So here's a little, and what this graph would say is if we were, again, at the time we were 25.10, obviously we're a little higher than that now, but you can see at expiration, 24.90 and under, we make about 2,000, which would be 10% return. And this is just one contract. So if you have any questions on that, just want to give you kind of a little feel, 3 strategies here today, at least give you kind of the get-go on these. So the setup, if I look at like a 4-step risk management plan, how do we set it up? You know, I set it up, or I like to do this when VIX is 11 and under. Markets are very high levels, which they are. I'm going to buy an in-the-money put near 60 delta, selling out of the money put near 34. You can see the duration I did. So in terms of step number 1 setup, you see how I'm structuring this. So that's step number 1. So in a 4-step risk management plan that I have developed, step 1 is the setup. How do we set it up? Step 2 is, what's my profit target and max loss? And then number 3, we'll get to what Dick's question if the market goes up. So step 2 is, what's my profit target and max loss? And generally on something like this, where the most I can make is about 10% or a couple grand on capital of 2120, so the most I can make is about 10%. So I might say, hey, I'm going to look to make about, so again, we talked about step 1, right? We talked about step 1, the setup, right? Step 1 was the setup. Let me see here. And so step 1 was the setup. Step 2, profit target and max loss. So let's say I'm trying to make, and again, this is a 30-day trade. My shorts are 30 days from expiration, my longs are 44. Let's say I'm trying to make 7%. 7% on what? 7% on my margin of 2120. So 2120 times 7%, we're going to make about 150 bucks, right? So if I paid 2120, right, where would I put an order in to make about 7% or 150 bucks? So I bought it for a debit. Where would I put my order in if I paid 2120 debit? Where would I put my order in to sell this out at a credit to make 7%? What's the answer? Anybody know? So if my words, I talked about step one in our 4-point profit risk management plan setup. Number two, profit target and max loss. So profit target, if I'm trying to make 7% and I pay 2120, where am I going to sell this out for? Does anybody know? Anybody know? No? So 2120 times 7% is 150 bucks. Right? Dick's got it. So 2120 debit plus $1.50 is $22.70. So if I pay 2120, I'd have an order in to sell it at $22.70 credit. I'd have that in at all times. Now, talked about profit target. What's my max loss? It'd be about 10%. If I'm looking to make 7%, I don't want to lose more than 10%. Well, 10% on 2120 is about $212, 210 bucks. So if I pay 2120, when this debit gets to around 1920 or 1910, that's when I want to kind of get out. Does that make sense? So what am I going over with you right now? A plan. Anybody could put a trade on, right? So I gave you the setup, why I would do the trade. I gave you the setup, step one. Step two, kind of profit target and max loss. What am I looking for? But so I have, if it goes up, right? So part one, Dick, is if it goes up in this spread, gets to around in this spread that I pay 2120, if it starts getting around 1910, I'll get out. Agree? So if the market goes up, what do? I just told you. Now, that's the ultimate plan. Now let's go, if I wanted to, step three, now I don't have to adjust. I could just say, hey, I have my plan when I'll take it off for profit on the downside or where I'd take it off for a loss on the upside. But what if I wanted to adjust? What could I do to try to help the position on the upside if it's going against me? So there's two steps here. Not only how do I fix it, but when do I fix it? If you fix it too late, it doesn't matter, right? So just, I mean, again, I'm trying to be quick here and going over this is, I don't know if I'll be able to do this for every trade, but I'm just trying to give you kind of a plan here. What do? You don't just whip this stuff on. But step three, if I was going to adjust, I'll just leave it for this for now. If the most I'm willing to lose is 10% before I get out of the trade, maybe when I'm down about 4% on this trade is kind of where I'd be looking to adjust this. Dan, what would that be? Well, if my margin's 2120 times 4%, so I'm down for one contract, but I'm down about $85, right, as we're moving up. If I'm down about $85 on this trade, then I may look to fix it. What's a possible fixing? It could be something like this. So again, I'm long one NOV 10, 25, 30 put, sell one OC 27, 24.90 put. An adjustment would be something like this, just give you an idea. Buy one of your shorts, the 24.90 put, and roll it up. Sell one 2,500 put. Dan, what's that called? It's called a put credit spread. So again, I've gone over with you why I would do this, what's the setup, what's the profit target and max loss, when I would adjust, and kind of how I would adjust. Did you get that? So you got a plan here. We're not just trading by the seat of our pants. Does that make sense? A little bit? Does anybody but Dick understand anything of what I'm talking about? Yes or no? Does anybody other than Dick have any idea what I'm talking about? Or am I just talking Spanish? Okay, good. Don Prattle, who's traded at the CBOE for many years, he understands. All right, good. All right, so next strategy we'll go over. All right, here's another strategy that, and we'll go over this, that is another one that works well if the market goes up, it works well if the market goes down, and I'm just going to show you where it gets in trouble. So this would be called a callback spread out of the money. So, excuse the poor graph, but let's go through this one. So first of all, when would I do this type of a trade? If I thought the market was going to go down, or if it was going to go up fast, but I thought it was going to move away from the current levels, 20, 30 points, right? So the current levels, when I did this slide on September 27th, was 25.11, right? When I did this slide, it was around here, 25.11. Okay, that's where the market is. And this is the trade, right? So it's a trade that benefits if the market goes up, if it goes down. Let's go over this. This is called a callback spread out of the money. And so, again, just like the previous trade that I gave you, these are trades that could be a hedge against your portfolio on the downside. But again, I'm teaching you how to manage them even if we're wrong, right? So let's start with this 4-step risk management plan. Let's start with the setup, right? We said this is why would we do this? This is a trade that can benefit if the market goes down or up. We just don't want it to do nothing or slowly move up, which we've been doing. But let's talk about this. So this particular example is a 30-day trade, talking the setup, so 30-day trade. All right, and I look at the underlying, so you can look whatever the underlying is today. So I'm telling you how to set it up. Obviously, I'm looking for a move one way or the other. I prefer the move down, but it's okay if it goes up. So with the underlying at 25.11, how do I do this? I start out by looking for I'm in the calls. I go 30 days out. I want to sell one, right? I want to sell one 30-day call. And I want to choose the strike by selling about a 30-31 delta. So I'm going to sell an out-of-the-money call. I'll choose the strike by selling about a 31 delta. So here I'm selling 30 days out as of SEP 27, the OCT 27, 25, 35 calls. And then I'm going to buy two, same expiration, 25, 55 calls. So my long call is about 20 points higher than my short. The key is I want to get my position deltas close to zero, okay? That's minus 0.93. So again, the setup, it's 30 days from expiration, all calls. The strike I'm selling is a 30-31 delta. So with SPX at 25.11. I'm selling the 25.35 call in this example, about 24 points out of the money. And I'm buying two OCT 27, 25.55 calls. The delta of my long call is 15. Generally, I like to do this strategy when the VIX is between 9 and 11. Okay? So again, I'm buying two OCT 27, 25.55 calls. My long call is going to be about a 15 delta. And I'm going to sell about a 30-31 delta 25.35 call. So it's called an out of the money call back spread. Both options are out of the money. And the nice thing is I'm doing this for a credit. So I'm doing it in this case for 250 credits. So on the downside, the entire downside, I'm making this credit, right? So there's no risk to the downside, and you just make my credit. Here's the underline right here. So you can see on the upside, this is the expiration graph, right? I do great 25.35 and under. So if the market goes down, I do great. If the market sits, I do great. If it goes a little bit up, I do great. If it goes up fast, I do great. It's just that one scenario at expiration, I don't want it anywhere near my long strike at expiration. It's kind of the sea of death. That's where I would get hurt. And the way you can avoid it is a simple rule. Since this is a 30-day trade, the most I'm going to stay in this trade is about 20 days, 20%. Excuse me, let me say that again. To avoid this sea of death, which would be at expiration, the slow grind up to the long strike, I'm only going to stay in this trade 20% of the duration. So if my duration is 30 days, 20% of 30 is 6, I'm only going to stay in this trade 6 days. Because you can see the day I put this trade on September 27th, this is how the graph looks. In blue is the expiration, but you can see how the graph looks the day I put it on, right? More like that. So as long as I only stay in this trade 20% of the duration, it's extremely low risk. So I gave you some risk management to avoid the bad spot. And again, you make money if it goes down. You make money if it goes down a lot. You make money if it goes down a little bit. You make money if nothing happens. You make money if we go up a little bit. You make money if we go up fast. You know, the first 20% of the trade. It just, your weak point here is over time, if we start creeping up near that long strike, anywhere near that, you go into the sea of death or Bermuda Triangle. So anyways, again, this is a trade. Unlike the previous trade, you can make money on the upside, but you can make money on the downside. So both of these would be hedges for the downside. I won't go through the whole 4-step risk management plan on this just to save time, but at least I gave you the, the downside. I'm basically trying to make the credit. On the upside, I'm not staying in this more than 20% of the duration, 6 days, so I'm not going to get hurt bad at all on this thing. But I want to be out in 6 days. Does that make sense, basically, what I'm doing on this? So these are a couple trades. These would be speculative trades, not the typical, not the typical trade I do every day. What we do every day with our students is put an iron condor, calendar, butterfly, put it on every week to try to make monthly income. And that's our bread and butter. These are a little more situational, speculative trades that fit well in this theme of this October coming up. All right. And then the last strategy would be something a little more closer to what we do, kind of an income trade, but how do we hedge it for the downside, right? What if we one second. how do we hedge these things? So here's an example. Anybody ever do a broken wing butterfly in here? Anybody ever do a broken wing iron butterfly? Sounds very complicated or but it's not. It's just a simple income trade. So again, here's a broken wing iron butterfly. And this is something we've used effectively the last couple of years. So with the underlying at 25.16 in this example right here, I put on a butterfly. First of all, let's start with the foundation of this broken wing at the money iron butterfly. The foundation is I'm selling, and in this example, the OCT 31 expiration as of September 29th was 32 days from expiration. So I'm selling a 25.20 call and a 25.20 put, which is basically at the money, right? If we're about 25.1681, almost 25.17, there is no 25.17 strike. So if I'm selling an at the money call and put, what do you call that? The foundation of this strategy is an at the money call and put. What do you call that in option strategies if I sell an at the money call and I sell an at the money put? What do you call that in option parlance? If I sell an at the money call and an at the money put. Anybody? Do you know what that is? What is that called? I'm going to sell an at the money call and an at the money put. That's the foundation of this strategy. Anybody know what that is? Yeah, it's a straddle, a short straddle. Sell an at the money call and put. Why would you sell an at the money call and put? Why would you sell an at the money call and put? It's because those options have the most time premium. So those are the options that could decay the most. You're selling the most time premium, the options that could decay the most. So that's if you're trying to, like an insurance company, bring in premium each month, that this is a trade like a calendar where you're selling at the money option, but this butterfly where I'm iron butterfly where I'm selling the at the money call and put right at the money. So I'm selling the two options that have the most time premium, your at the money options. So those are going to decay really quick. And then I'm buying just some hedges because I don't want to be naked options because the margins or risk is too high. So I'm going to buy my call option about 30 points higher than my short call. And I'm going to buy my out of the money put 40 points lower. So as a hedge, I'm going to buy my out of the money calls 30 points higher than my at the money calls. I'm going to buy my out of the money puts 40 points lower than my at the money puts. And you may say, hey, Dan, why are your puts 40 points lower that you're buying and your calls 30 points higher? Well, it's because the volatility skews in the indexes, specifically this is SPX, specifically SPX and RUT. Your out of the money calls are going to be much cheaper. Your out of the money puts are going to be more expensive. So if I'm buying, the reason I do this 30 points to the upside, my longs, and on the downside, my puts are 40 points lower, that's where you get this broken wing, right? Broken wing just means the width on the call side is different than the width on the puts. We call broken wing. And the only reason I do that is to get your position deltas closer to zero. So this is a little more non-directional. Again, this is the expiration graph, and this is the graph when I put it on. So I want this a little smoother here, circling the price at the time. Because if I did it balanced, 40 width on the downside, the put credit spread, and 40 on the upside, I'd be probably 10 deltas short. So because of the volatility skew, if I wanted a little bit closer to zero, the deltas, I I have to do it this way. So the question says, do I look at the delta in picking the buys? No. Do I look at the deltas in picking the buys? No, I just pick them with the width. Well, yeah, I don't want to get into that. I'll just tell you this. For like a 30, this is about a 30-day butterfly. I'm going to be about this width in the SPX. I'm going to be about 40 wide on the downside. But the way I do the width on the upside is I want to get within about 2 deltas. So on a 30-day trade, I'm going to be about 40 wide on the put side, 30 wide on the call side. But again, the goal is to get within about 3 deltas. As my duration, if I get like 10 days from expiration and I'm going to do a butterfly, my width would be narrower. If I was going to do a 60-day butterfly, my width would be wider. But again, the whole reason for doing butterflies, and we do these types of butterflies every week, over and over. Like every Wednesday, you could put on a 30-day butterfly. And we do that and then you just manage the risk on it. But the key is you're doing it because these are positive theta. Your short options are going to decay quicker than your long options. Why is that? Because you're selling more time premium in your shorts than you are in your longs. So if you look at the expiration graph here, you have less risk on the upside because your call credit spread on the upside is narrower than your put credit spread. Here's the whole graph. Again, here's the zero P&L curve. So you can see if this is the underlying, why do you make so much money at expiration if it doesn't move much? Well, because if it were to expire right at 25.20, all the options we sold with the massive amounts of time premium would go to zero. And these would hold some value, our longs, and our credit, we'd be able to buy this butterfly much less than we sold it. So again, these are repeatable trades that you can do over and over and over till the cows come home. So in this, again, this presentation today probably be more medium level or advanced. So it's going to take you out of your comfort curve. If you're just used to, look at a chart, looks like it's going up by a call or a call spread. If it looks like it's going down by a put or a put spread, and there's nothing wrong with this. This would be a little bit of diversification. And these trades have done great over the last 2-3 years as the market's been going up, not at a fast pace, and range-bound trades have been really well. Anyways, this would be a broken wing at the money iron butterfly, where the width of my call credit spread on the upside is 30, the width is 40 on the downside. I'm bringing in a credit of $23.35. My risk on the trade is $1,665, and it's the downside because my upside risk is less. And so we've been doing this broken wing butterfly on the upside the last couple of years, and it's worked well because we've had less risk on the upside, and we're starting out our deltas close to zero. I use this primarily with SPX and RUT, even though you can do it with SPY, IWM, and Q. We favor SPX and RUT. And then finally, here would be an example just, like in the current market, what I could do is, if I wanted to keep the deltas about the same as the previous example, but maybe have a little bit of put insurance to help me on the downside, right? If we actually get a correction one of these days, what I could do is, let me just see the strikes I did here on the downside. Okay. So all I did here is, and you can do this with any position, here's the same butterfly that I did basically before. But all I added is, we call these little baby puts, right? A 4 delta put. It's going for $2. I just bought a small little put against this trade, and that can help me if we have a big move down. The only thing I want to just tell you, when you're buying out of the money puts, maybe against income trades as insurance. So in this example, with the price at 25.15, I'm buying, let's say, an OCT 31, 32 days from expiration as of the time I did this slide, September 29, and I bought the 23.20 put. So I'm buying a put 200 points out of the money for $2. Now, you got to be very careful when you're buying out of the money puts, and again, use as a guideline if as I was putting this trade on, the OCT 31 was, let's say, 32 days from expiration, the longest I would count on this put helping me would be 20% of the duration of 32 days, which would be about 6 days. Because what happens is, if you have an out-of-the-money put, a put that's 200 points out of the money, as you get closer to expiration, even if we go down, that put could still go down. Why? Because you're getting too close to expiration. So I think as a general guideline, if you're ever buying out of the money puts as insurance, whatever duration you buy them, only stay in those puts about 20% of the duration. That would be my advice. If you get to that number, so this is like 32 days and I'll hold it for 6 days, after 6 days, I'm either going to have to roll the put up or further out duration. Anyways, just some things to think about. I know this is a lot to throw at you, but if you have any questions, you can email me at dan@sheridanmentoring.com. I'd be happy to help you. But these are just some things to think about. If you have a butterfly or an iron condor, buying it out of the money put, but helping giving you a little bit of information on an out of the money put when it could start to hurt you. And that's why I gave you that little guideline on duration. And then we talked about a back spread and a covered right for the downside. So these are some strategies. And what I would recommend is, the only way you're going to learn this or anything in life is doing it, right? Maybe do it on paper a little bit, and then maybe do one contract live. If you got a bunch of covered rights on, do one contract so you can understand, go to TradeStation, do one contract and get used to it, right? And this could be a compliment to you. So anyways, I'll let you go there. If you have any questions, let me know. I'll hang around here for a few minutes. And Don, I'll turn it over to you, buddy.
Yes, I am here.
No, I use mainly SPX and RUT.
Got it. Right. So that, I think, wraps up our presentation today. I want to thank everybody for attending. And as I mentioned, this is being recorded. It will be restored in the TradeStation YouTube channel sometime later in the week. And we want to thank Dan Sheridan for spending his time with us today. He's an excellent presenter, and certainly this is his, right in his skill set, these types of trades, and he's taught many traders how to be successful using them. So I want to thank him for his time today. And certainly, if his service can be of use to you, as Dan mentioned, certainly reach out to Sheridan Options Mentoring to talk to Dan and Dan's team of able-bodied professionals.